You paid into Social Security across an entire career, using money the government had already taxed once. You reach retirement. The government taxes your benefits a second time. Then your 401k forces you to begin pulling money out at age 73. That withdrawal pulls even more of your Social Security into the taxable category, and your actual marginal rate inside what appears on paper to be the 22% bracket quietly rises to 40.7%. Then Medicare notices the income increase and raises your premiums 2 years later, long after you have forgotten what set it off. And by the time that bill shows up, there is absolutely nothing left you can do about it. 3 toll booths, 1 road, and every piece of conventional retirement advice only warned you about the first one. Here is what is genuinely happening, with the real numbers to back it up. Total retirement assets held across the United States reached $49.1 trillion as of December 31st, 2025, representing 34% of all household financial assets in the country. Americans held $10.1 trillion of that total inside 401k plans alone. Every single pre-tax dollar sitting in those accounts is a deferred tax obligation the government has already mentally earmarked. They are not going to make collection easier for you. I spent the last 10 years building a business surrounded by accountants, tax attorneys, and people who genuinely read the tax code for recreation. Multiple hundreds of thousands of my own dollars are invested. This is not abstract theory, and what I am about to take you through is information I have never seen assembled in one place, with the actual math laid out clearly, anywhere in mainstream financial media. The framework I will use throughout this entire video is straightforward. Think of tax-deferred retirement accounts as a road. The government told you there was one toll at the far end, one payment. You put money in before taxes, it grows untouched. You pay income tax when you take it out. One toll booth. That was the sales pitch. The pitch was incomplete. By the time you are actually traveling that road in your 70s, there are 3 toll booths waiting for you, and they are positioned so tightly together that triggering one almost automatically sets off the next. The toll booth was never where they told you it was. Remember that phrase because we will return to it repeatedly. Let me walk you through all 3. I will show you the real math at each one. Then I will show you the detour. In a few minutes, I will walk you through the precise calculation of what happens when required minimum distributions and Social Security benefits land in the same tax year simultaneously. The figure of 40.7% effective marginal rate inside the 22% bracket is among the most quietly destructive things I have ever encountered in a tax document. But first, there is a slower and far less visible problem that has been compounding quietly for 4 decades. It is the toll booth nobody bothered to post a sign for. Here is a story. A man named Harold spent 35 years working at the same manufacturing facility in Ohio. He and his wife paid FICA taxes out of every single paycheck from 1972 to 2007. They never gave it much thought. The arrangement seemed obvious. Pay in now, collect later. It was never spelled out explicitly in writing, but the original 1935 Social Security Act positioned benefits as retirement insurance, not a taxable income stream. They carried a reasonable expectation that what eventually came out of the system would reflect what they had contributed to it over a lifetime. Congress changed that arrangement in 1983 under President Reagan, and this is not a political observation because both parties have upheld this change ever since. The Social Security Amendments of 1983 created federal income taxation on Social Security benefits for the first time in the program's history. The Greenspan Commission, which engineered the restructuring, estimated this change would affect roughly 10% of beneficiaries, exclusively the highest earners. The thresholds they established were $25,000 in provisional income for single filers and $32,000 for married couples filing jointly. Above those levels, up to 50% of your benefits became taxable income. A decade later, in 1993, Congress introduced a second tier. Above $34,000 for single filers or $44,000 for married couples, Up to 85% of your Social Security benefits become subject to federal income tax. Now, here's precisely where the toll booth analogy earns its place. Those thresholds were established in 1984 and have never once been adjusted for inflation. Not a single time. Not in over 40 years. The provisional income thresholds used to calculate the taxable portion of Social Security benefits are fixed by statute and carry no indexing for inflation or wage growth whatsoever. The intent embedded in the original 1983 legislation was that eventually, across a long enough timeline, there would effectively be no meaningful thresholds remaining, and all Social Security benefits would ultimately become subject to federal taxation. Read that sentence again. That was the documented intent. Congressional record. Gradual bracket expansion built in by design. The IRS adjusts its ordinary income tax brackets every single year to reflect inflation. Those thresholds move. The Social Security provisional income thresholds, the ones that determine whether your monthly retirement check gets taxed, are permanently frozen. The mechanism is simple and it is relentless. Social Security benefits receive cost of living adjustments annually. The Social Security Administration announced a 2.8% COLA for 2026. Every COLA increase raises the portion of your benefits that counts toward provisional income. Your investment income grows over time. Your IRA distributions grow as well, but the threshold that decides when taxation activates never shifts an inch. It was a one-way ratchet, and it was engineered to function exactly that way. Harold's son Derek just turned 68. He earns approximately $94,000 in combined provisional income from Social Security and a modest IRA distribution. Derek is not wealthy by any reasonable definition. He drives a 7-year-old truck and still carries a mortgage. But by the 1983 standard, he sits in what was originally intended to be the uppermost income tier in America. What represented a high-income threshold back in the 1980s now describes a thoroughly middle-class income level. A married couple earning $96,000 today occupies essentially the same economic position as a $32,000 couple did in 1984. Yet only the modern couple pays federal income tax on their Social Security income. The outcome is a quiet, automatic tax increase that sweeps in more retirees with each passing year. The taxable portion of Social Security benefits as a share of total benefit payments grew from 12.2% in 1994 to 38.2% in 2022. That is a tripling over 4 decades. Zero new legislation required. The frozen threshold did all the work silently and automatically. The Greenspan Commission projected that 10% of Social Security recipients would face benefit taxation. A rule constructed to capture only the wealthiest 10% of retirees in 1984 now reaches roughly half of all Social Security beneficiaries. A Social Security Administration analysis projected that over 56% of beneficiary households will owe income tax on their Social Security benefits by 2050. Had these thresholds been indexed to inflation from their original levels using the Consumer Price Index, the single filer threshold of $25,000 would stand at approximately $80,000 today, and the upper threshold of $34,000 would be approximately $110,000. The actual 2026 thresholds of $25,000 and $34,000 sit dramatically below their inflation-adjusted equivalents, meaning that a retired worker whose income today would have been considered solidly middle class in 1983 faces full 85% taxability on their Social Security under a threshold structure originally designed to reach only higher income retirees. The first toll booth was never where they told you it was. At this point, you might be wondering whether the major tax legislation Congress passed in July 2025 resolved any of this. It introduced a $6,000 senior bonus deduction for taxpayers age 65 and older. That sounds like meaningful relief. Here is the reversal. You may believe the senior bonus deduction addresses the Social Security taxation problem. It barely makes contact with it. The IRS will continue applying the identical formula it has used for the past 40 years to determine how much of your Social Security income is subject to federal tax. The income thresholds have gone unadjusted for inflation throughout that entire period. Depending on your total income, anywhere from 0% to 85% of your Social Security benefits remains potentially taxable. The underlying Social Security tax thresholds from 1984 are completely frozen at $25,000 for single filers and $32,000 for married couples. This new deduction is temporary and scheduled to sunset after the 2028 tax year. It also phases out for single filers earning above $75,000. The retirees who need it most frequently will not qualify for it. The formula designed to phase taxation in as a function of income, never corrected for the tripling of inflation that has occurred since its creation, remains entirely intact. The major 2025 tax legislation made permanent the lower marginal brackets, the expanded standard deduction, and the estate tax provisions. Most individual provisions from the earlier tax law had been scheduled to expire at the close of 2025, which would have reverted rates to 2017 levels and triggered tax increases for roughly 62% of all filers. According to the Tax Foundation, keeping rates where they currently sit was genuinely positive news, but it accomplished absolutely nothing regarding the Social Security provisional income formula. The first toll booth remains fully operational. They handed you a discount coupon most people cannot use, set it to expire in 3 years, and left the underlying calculation completely unchanged. Stay with me because this next section is where the math becomes genuinely alarming, and it connects directly to the money sitting in your 401k right now. Picture yourself at 73 years old. Traditional IRA Social Security income coming in. On paper, you are comfortably inside the 22% federal tax bracket. You need $10,000 for an unexpected expense, a medical bill, a home repair, whatever the situation demands. You pull it from the IRA. Your instinct says $10,000 multiplied by 22% equals $2,200 in tax. That is standard bracket arithmetic. The actual federal tax on that $10,000 withdrawal is closer to $4,070, representing a 40.7% effective rate sitting inside the 22% bracket. Financial professionals commonly refer to this stacking effect as a tax torpedo, a marginal rate spike that occurs when each dollar distributed from a retirement account drags additional Social Security income into the taxable base. A senior financial planner at T. Rowe Price illustrated this dynamic, using the example of a married couple whose additional $1,000 IRA withdrawal generated $407 in federal tax rather than the expected $220. The marginal rate on that single withdrawal climbed to 40.7%, because the same dollar simultaneously pulled $850 of Social Security benefits into taxable income. Here is the mechanical explanation. Every additional dollar withdrawn from the IRA carries another 85 cents of Social Security income into the taxable column. So each new dollar of withdrawal actually produces $1.85 of new taxable income, all taxed at the 22% rate. $1.85 multiplied by 22% equals 40.7 cents of tax per dollar withdrawn. That is not your marginal bracket. That is an effective rate nearly double what the IRS rate table shows you. The tax torpedo occurs when multiple income sources, including required minimum distributions, Social Security benefits, and capital gains interact in ways that produce an unexpected spike in your actual marginal tax rate. Without deliberate advance planning, retirees can find themselves paying far more in taxes than anticipated, even on relatively modest retirement incomes. Here is a real-world illustration of how this plays out. A woman named Carol retired at 66 following a long career in healthcare administration. She followed the conventional script precisely, maximized her 401k contributions for more than 20 years, rolled everything into an IRA at retirement, and claimed Social Security at 66 because her advisor recommended against waiting beyond full retirement age. She held $980,000 in her IRA and was told she had done everything correctly. Fast forward to 2026. Carol is 73 years old. Required minimum distributions from traditional IRAs and 401ks begin at age 73 under current law. Her IRA, having continued to grow, now sits at approximately $1.2 million. Her first year RMD using the IRS Uniform Lifetime Table Divisor of 26.5 for age 73 comes to roughly $45,000. She receives $30,000 annually from Social Security. Her combined provisional income now sits well above $70,000. 85% of her Social Security benefit, $25,500, is fully taxable. Her effective income tax on the RMD alone is not 22% of $45,000. It runs closer to 28 to 30% because the stacking effect pulls her Social Security income into the calculation, and her actual marginal rate on any additional dollar she withdraws exceeds 40%. She did nothing wrong. She followed the advice she was given. The advice was optimized for the accumulation phase and contained no meaningful model for the distribution phase that followed. Here is what compounds the problem further. RMD income routinely pushes retirees into higher IRMAA brackets, even when their actual spending has not changed at all. The result is bracket creep, or in some situations, a sudden leap into substantially higher marginal rates. And the RMDs themselves do not hold steady. On a $1.6 million traditional IRA, a first-year required minimum distribution runs around $60,000, and the divisor decreases every subsequent year, forcing progressively larger withdrawals as the balance continues to compound. If the account keeps growing without distributions, first-year RMDs can climb north of $150,000, all taxed as ordinary income stacked on top of pension income and Social Security. The IRS table requires larger and larger percentages of the account to come out with each passing year, compounding the torpedo effect continuously, and you have no choice in the matter. The penalty for failing to take a required minimum distribution is 25% of the shortfall. The IRS is not making a suggestion. It positioned the toll booth precisely where the road narrows most, and stopping to pay is mandatory. The second toll booth was never where they told you it was either. Here is the element that virtually never appears inside a standard retirement calculator. Understanding these numbers intellectually is one thing. Having a specific sequencing plan for navigating all three simultaneously, with your actual account balances, your actual Social Security timing decisions, and your actual Medicare exposure mapped out, is something of an entirely different magnitude. I built a resource called the Exit Code specifically because I could not locate that kind of plan assembled anywhere else. It is a digital book built on 50 years of actual retirement data, not generic platitudes, but a genuine mathematical framework. Two components inside it connect directly to everything we have covered so far. The first is the dynamic withdrawal method, which replaces the standard 4% rule and accounts precisely for the Social Security and RMD stacking effect we just walked through, so you are not inadvertently withdrawing yourself into a 40.7% effective bracket without realizing it. The second is what I call the 58% rule, a calculation built around the risk of a forced financial disruption in your late 50s or early 60s, before you have had sufficient time to reposition your pre-tax accounts. That particular scenario hits people harder than any standard retirement model acknowledges, largely because every standard model assumes you control the timing. Very often, you do not. It is available through the link in the description for less than the cost of a dinner out. And every year this math remains unfamiliar to you, the compound interest on that gap in understanding runs steadily in the wrong direction. Now, the third toll booth. This one does not arrive when the income event occurs. It arrives 2 years afterward, and by the time it does, there is nothing you can do to change it. The underlying subplot running through this entire video is the question of what conventional retirement advice was actually optimized to accomplish. The industry grew up helping people accumulate assets. The fee structures, the product design, the marketing materials, the dinner seminars at hotel conference rooms, all of it centered on directing money into accounts. Advisors were compensated based on assets under management during the accumulation phase. The distribution phase was almost never modeled with comparable rigor, and nowhere was that gap more financially costly than in what I am about to describe. Beyond federal income taxation, required minimum distributions can also raise your Medicare Part B and Part D premiums through a mechanism known as the Income-Related Monthly Adjustment Amount, commonly referred to as IRMAA. Medicare uses a 2-year look-back period, meaning your 2025 income will determine your 2027 Medicare premium levels. Here's how IRMAA functions mechanically. If your modified adjusted gross income from 2 years prior exceeds certain established thresholds, your Medicare Part B and Part D premiums increase substantially. The additional cost for 2026 can range from $284.10 to $689.90 per month. For Medicare Part B alone, depending on how far your income exceeds the applicable threshold, and that figure applies per person. If both you and your spouse are enrolled in Medicare, a single income event can trigger surcharges for both of you at the same time. One household income spike produces 2 separate bills. You might assume IRMAA will not apply to your situation, since your 2026 income would need to exceed $106,000 as a single filer and $212,000 as a married couple based on your 2024 reported earnings. Here is why that reasoning deserves closer examination. At what feels like the most inconvenient possible moment, you retire at 68. Your income remains modest for several years. Then at 73, the first required minimum distribution arrives. Your IRA has been compounding undisturbed for years. That RMD might reach $50,000 to $70,000, sitting directly on top of your Social Security income. Your combined reported income crosses the IRMAA threshold. 2 years pass and it is now 2028. Your Medicare premium notice arrives noticeably higher for the entire calendar year for both of you, and you are completely unable to appeal it because changes in investment income, large IRA distributions, and Roth conversions do not qualify as life-changing events eligible for an IRMAA appeal. IRMAA operates as a cliff structure, not a gradual slope. Crossing a threshold by a single dollar costs you the same amount as crossing it by $10,000. If your income lands in the next bracket by just $1, your Medicare premiums can jump by more than $1,000 per year immediately. If you are married and both enrolled in Medicare, that same single dollar of excess income can cause premiums to rise by over $1,000 annually for each of you. Here is an example drawn from a 2026 analysis. A 73-year-old retiree holding a $1.9 million traditional IRA faces a mandatory withdrawal of $71,698 in 2026. That figure, combined with $42,000 in Social Security income, pushes her gross reported income to $114,000 and triggers the applicable Medicare premium surcharge threshold. This adds roughly $1,500 annually to her Part B and Part D costs, with a cumulative 5-year financial impact approaching $7,500. Because IRMAA functions as a cliff, a single planning misstep, whether from a large Roth conversion, a property sale, an unexpectedly substantial RMD, or an inherited account distribution, can push a household into the next premium tier and lock in elevated costs for a full 12 months. And because the tax year being measured sits 2 full years behind the premium year in question, the consequences arrive long after most retirees have forgotten what set them in motion. The psychological dimension of this deserves a moment of attention on its own. IRMAA was structured to be effectively invisible until it lands. The 2-year delay severs the connection between cause and effect in a way that makes attribution nearly impossible for most people in retirement. You take an IRA distribution in 2026 and pay the resulting income tax. That feels complete. You move forward. Then in 2028, your Medicare premium is higher. You assume it is general inflation. You assume everyone received the same increase. You have completely forgotten the 2026 income event that caused the specific adjustment to your premium. The system is structured in a way that rewards forgetting. Here is a brief scene that captures this precisely. Picture a retired engineer reviewing his Medicare statement with his adult daughter in late 2028. She asks why the premium increased. He genuinely cannot recall. He assumes it must reflect some new policy change. She investigates. It traces back to IRMAA, triggered by his income from 2026, which included his first required minimum distribution, the one nobody explained would also generate a Medicare surcharge arriving 2 years in the future. He absorbs the information slowly. Well, he says quietly, that is disappointing. His daughter writes the check. That is the third toll booth, and it was never included on the map they handed you. Most Americans hold the majority of their retirement savings inside pre-tax accounts. Mandatory income generated by required minimum distributions can push retirees into higher federal tax brackets, activate taxation on Social Security benefits, and increase Medicare premiums by thousands of dollars annually through IRMAA. This layering effect, combining ordinary income, IRMAA surcharges, the net investment income tax, and capital gains compression, is what many advisors refer to as the retirement tax bomb. Let me now show you a fourth mechanism that extends the same system forward into the next generation. Because the deferred tax obligation does not simply disappear when you die, this is where the story becomes genuinely interesting, and I mean that with every bit of amused disappointment I can summon. Before the Secure Act of 2019, when you left your traditional IRA to your children, they had the option to stretch distributions across their own expected lifetime. They could take modest required minimum distributions annually, keeping the resulting tax burden manageable year by year. Congress eliminated that option entirely. Non-spouse beneficiaries who inherit an IRA established after January 2020 now have exactly 10 years to completely drain the account. Full stop. No annual minimum withdrawal amounts are mandated, but the entire account must reach zero by the end of year 10.